Frank Rohde joins me here today. You can learn what his team is up to, which is a unique one. So definitely check out ownify.com, ownify.com. I really appreciate your time here, Frank.
Thanks for having me, Jack.
So first off, we got to kind of break down or summarize what Ownify is up to here.
So as the name suggests, we turn renters into owners, and Ownify is really focused on helping first-time home buyers get into the market, right, buy their starter home through a new and differentiated structure. So not a mortgage, but an equity-based path into ownership.
What do you mean by an equity-based path to ownership?
Yeah. So if you think about the way we've traditionally bought homes, right, for the last 70, 80 years, is you buy the home, really more accurately, you obtain title and then you use debt to, finance that transaction. You pledge title to the lender and you pay it off over 30 years. And you actually don't really own the title free and clear until you've paid off that debt, right? So, and that's a 30-year, usually conventional conforming product. And so what we did is we kind of rethought the journey here to say, what if we allowed people to buy their home brick by brick? Or really, most homes in the US are made out of sticks, but brick by brick just sounded better. So fraction by fraction. And what we've built is exactly that. We said, can we turn homes into 10,000 ownable shares or bricks? And so if you think about a $400,000 median price home, or the starter home maybe at 300,000. If we turn that into 10,000 bricks, we can sell a brick for $30 and allow a customer to build equity over time by buying bricks over time, right? With increments, monthly payments. And so structurally what we've done is we've created exactly that. It's a journey, a 5-year program where we underwrite and qualify customers up front. So consumers come to us, first-time home buyers, renters come to us. They get pre-qualified on the Ownify website and underwritten for a specific budget. And we say, congratulations, Jack, you're qualified for a $400,000 home budget based on your income, based on your credit. And then what we do is we partner you with an agent, realtor, real estate agent. You go out and you find a home. You submit that home for a secondary underwriting with Ownify. And if it meets the criteria, we purchase the home as an all-cash buyer. And we then place that home into an entity, and you're a real estate professional, so you'll appreciate this. We place each home into a single-purpose LLC, limited liability company. And that entity issues 10,000 shares or membership interests. The customer now signs an agreement that really has 3 components. The first component is a lease agreement, right, between themselves and the LLC as the landlord. So I'm leasing the home for 5 years. I have the rights to live in the home. I have a fixed, payment plan for that 5-year period. The second agreement is that as part of that fixed payment plan, I'm purchasing incremental bricks, incremental membership shares or interests in the home every month. My day one contribution is 2%. So that's the minimum down payment, if you will, or initial purchase. 200 of the 10,000 bricks are bought by the customer on day one. And then every month I buy incrementally more bricks until I get to roughly 10% at the end of 5 years, or 1,000 of the 10,000 bricks, right? And that allows me to build equity without having a loan, without having debt. And while I'm living in the home and I'm building equity, I'm renting the bricks that I haven't bought, right? So on day one, I pay rent on effectively 9,800 bricks. And over time, my rent actually goes down because I'm only renting whatever number of bricks I haven't bought at any point. And then the third component of the agreement is a purchase option that basically says at any point along the way, I can also buy the home outright from the LLC at whatever future market value. And I will use my accumulated bricks as part of that payment, as part of that transaction. So really the way the golden path is designed is, you use Ownify for 5 years, you build up 10% equity. And at the point of 10%, you pull the trigger, buy the home from the LLC, use the 10% as a down payment for a traditional mortgage. And then you own the home the way we've always done it, right? Fee simple title, and you pledge that title to the lender. So all 3 of these agreements working in parallel create this on-ramp for first-time buyers that basically allows us to lower the down payment hurdle, right, below what you would normally get from a mortgage lender. We can lower the monthly payment compared to what it costs today, creating a lower monthly payment. And at the same time, because it's a fractional ownership and fractional rental structure, we're protecting the customer from things like unforeseen repairs. We cover insurance, property taxes. And so all of those things kind of create an on-ramp that has a lower financial exposure, lower financial risk to the consumer. And when they're ready, they can take over and own the home the traditional way. Does that make sense?
Yeah, is it
Yeah.
fair to say that this is like are you using blockchain to do some of this?
Everyone always asks that. We are not. And we could, and we looked at it and we said, what's the real benefit here? And the benefit of a decentralized ledger really doesn't apply all that much here for a number of reasons. Ultimately, the reason we're fractionalizing through this LLC structure and we're holding this in a centralized ledger that we run is really because you can't fractionalize a title directly. And until you can, I think there's limited reasons to use blockchain to do this, but happy to dive into that.
Yeah, it sounds like new version of a rent to own program.
It has elements of rent to own. The biggest difference between what we do and rent to own is that rent to own is exactly what the name implies. It's rent, 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 and then you own. And what we've built is fractional ownership along the way. The membership interest in the LLC, the brick, is a bona fide ownership interest in that home, just like you have in commercial real estate, where if you invest in commercial real estate, you're buying membership interest in an LLC that holds title to that real estate. That's usually the structure. And so we've just found a way to replicate that in a very efficient manner using software and automating a lot of the processes and automating the ledger and the valuation so that we can effectively run a cap table, right, and an ownership ledger for individual single family homes.
So you're kind of pairing up the buyers and the investors. Like, how does that work? Do the investors come with you with the property in hand and then enroll them in your system?
So far, what we've done is on the consumer side, customer comes in and they pick a home and we underwrite the home. So we eventually, say yes to the home. And it's an underwriting process. Not every home gets accepted, obviously. On the investor side, investors actually come into a fund. And so that fund in return invests in each of the homes in a diversified manner. So as an investor, you're investing in a portfolio of single family homes that are co-owned by the individuals that live in those homes. And that structure is one, works from an SEC and securities law perspective. And two, also allows us to create instant diversification for the investor so that you're not exposed to the downside of owning a single home, right? And you have the ability to, even with a limited amount of money, diversify across dozens and hundreds of homes.
Mm-hmm. So do you see does the investor get kind of a ledger then saying you own so many bricks in this house and that house and this house, or is it just kind of a diversified fund?
What we have done is we've told our investors in their, quarterly updates, here's the portfolio of homes. They're all named after authors, right? So we started with the Atwood, the Baldwin, the Campbell, and so on and so forth. And they all know what the homes look like and they have pictures and, descriptions and all that. But we haven't gone down to the level of saying, Jack, your capital is distributed across 32 bricks in the Atwood and 25 bricks in the Baldwin. Sure. And so on. I think the real benefit is this notion of what's the return in terms of rental income, what's the appreciation, and how diversified am I, so that if one of these homes, for whatever reason, has a repair bill or maintenance bill that comes due, and maybe in that month or that quarter you have slightly lower rental income, that's balanced out by all the other homes.
So what's the benefit for the purchaser then? Because you said they have to come in with 2%. That's roughly what they would probably have to come in if they were to a first-time home buyer. Is it?
Most customers don't actually get down to the FHA loan is probably the closest you can get with a 3.5% down payment. The issue that a lot of our customers have had in qualifying or getting those mortgages is that with an FHA loan, you really can't win deals. And in any market that is even remotely competitive, sellers prefer better finance, either cash offers or the 10, 20% down conventional deal. So one big benefit is that we help you win, right? For the first time buyer, we come in as a cash buyer, we can negotiate, and we've been successful in negotiating discounts off of list because we come in as an all cash buyer. That's one big benefit. The second one is really this notion of protecting you and giving you the ability to own the home, own fractions of the home, build equity without having the exposure to either the repair, right, and the unforeseen expenses, or quite frankly, a dip in home prices. This is an important nuance to understand. For a first-time buyer, if you try to buy a home with a 3% or 5% down payment, and you have a very thin equity sliver, and as soon as home values fall, your equity's gone, right? And it could be gone. You could be underwater. And that's exactly what happened in 2009, 2010 with almost a quarter of the homes in the US.
West Coast.
Right? Certainly Florida and Inland Empire and, places of California, less so in the middle of the country. But you had this big exposure, right, to low down payment mortgages. And so as a first-time buyer, it's a big risk you're taking, right? You're basically taking the risk of being underwater, having negative equity. We're protecting the customer from that. Now, the flip side of that same equation is you don't have the risks or the exposure to a high leverage mortgage transaction. You also are not getting all the upside when home prices appreciate, right? And so in our structure, as a first-time buyer, you're sharing the equity upside with your investors, with the co-investors that come in. So it's really a lower risk transaction, right? Not just a lower down payment, it's a lower risk transaction kind of all in when you look at that kind of 5-year horizon. Because part of what happens with a low down payment mortgage is you're putting, let's say you put down your 3.5 or 5%, you then pay a mortgage that has an interest rate of 6.5%, but you're adding mortgage insurance on top of that. So that's another 100, 125 bips, depending on where you are. Depending on your credit score, your underlying rate might be higher. So now you had 7.5%. You had property taxes, that's another 100 bips. You had 8.5%. You had insurance, it's another, call it 25, 50 bips, right? Now you had 9%. And now you haven't created any budget for maintenance and repairs, right? So once you add that, you are at a monthly payment that is disproportionately higher than the payment we can charge today, right? And so in a way, it's not just the down payment, it's really the full package of monthly payment, down payment, risk exposure, right, that we're marketing to our customers. Now, the other thing that happened, which is really interesting, is the persona that responds really well to the Ownify offering. So if I look at the portfolio, the applications we're getting, and the folks who've ultimately ended up buying homes with us in this structure, they could get a mortgage, and they actually have really solid incomes, about $150,000 average income. They have an average FICO score of 720, so they have good credit, they have good income. But when you double click on, well, why haven't you bought a home with a mortgage? It's usually because of student debt. And that has prevented them from saving. And it also puts pressure on their kind of affordability calculation on a month-to-month basis to say, I'm paying down my student loan, right? I don't really want to stack a mortgage on top of that. The other thing that happens is with that level of income, you usually don't qualify for the down payment assistance programs, the Fannie Freddie, Home Ready, Home Advantage programs, right? Because those are all capped at 80% of area median income. So you're cursed by making too much money, but not having enough savings, right? And that persona out there, good income, good credit, not enough savings, that's really the sweet spot for Ownify.
So the path here is that they now own roughly 10%.
Roughly 10%, exactly. So that's the way the math works, right? And with 10%, you can get a mortgage, right? And conventional product and, take over the home. You have a bigger equity sliver, right? Most of our customers, no one has gotten to the 5-year mark yet, but if you look at the ones that are, in for 2 years and 3 years, their incomes have increased. And so they're in a better position to not take over maybe a slightly riskier value proposition, right? And quite frankly, a number of our customers are also expecting that mortgage rates are going to fall in that time horizon, if you look at these 5 years. And I think that's a reasonable assumption, right? They're not going to be in the 3% or even 2% range like we saw couple of years back, but they should be in the fives, right? Mid fives, which is kind of the long run average.
Just to remind everybody, head over to ownify.com to get more information of this program, ownify.com. If there's some value in what we're talking about, share this with one of your investor friends. And if you are watching us on YouTube, give us a like and subscribe.
Awesome.
Frank, we spent quite a bit of time on the who will eventually be the homeowner. And it sounds like they're going to take advantage of a couple things. The lower payments, it helps them earn that equity. During that 5-year time, the property is likely going to appreciate in value too. So is that part of the equity play there for them?
Yeah. So the customer is building equity through this share purchase of the brick purchase. And so as their bricks appreciate, they're getting their unlevered appreciation of whatever they own. And so as those bricks go from, let's say, $30 to 31, 32, 33, they appreciate just like stock or shares would. And so that's part of the goal, quite frankly, and the benefit of building equity is that you're participating in that appreciation. But again, unlike with a mortgage, you're not getting 100% of the appreciation. You're sharing it with a pool of investors effectively.
So at the end 5-year mark, they're actually getting a mortgage for the market value of the property after that 5 years.
That's exactly right.
Okay. So let's talk on the investor side, like how it benefits them. It sounds like rental income, and there's going to be appreciation and possibly there's likely a depreciation schedule associated with this too.
That's exactly right. So there are really three kind of ways in which this structure creates return for the investor, right? The first one is rental income, and that rental income is tax advantaged because you're getting the depreciation write-off effectively on each of the properties, right? So the way pass-through depreciation works through the K1 structure or K1 partnership return is that you get to deduct that from your income effectively. And so the properties generate rental income. And what's attractive about that is that in this structure, we don't buy a home until the customer has signed the contract and has picked the home. So we never have vacancy, right? You don't have lease up costs. You don't have marketing up front. The home is fully occupied, earning rental income from day one. That obviously generates incremental return and yield from an investor perspective. The second thing that happens in our structure is you have effectively co-owners living in the home, which means they take care of the property. And so far, we've seen about 60% lower maintenance cost than you would see in a normal SFR single family rental portfolio. And that's what you would expect with customers acting like co-owners rather than acting like tenants, right? And we do little things like, we send us a video of you draining the water heater and we'll send you an extra brick. And it's just reinforcing this notion of you're a co-owner, right? Rather than just a tenant. And we expect that kind of behavior ultimately results in better appreciation of those properties as well. So that's the rental piece, right? There's tax advantage, and structurally you have these kind of benefits of co-ownership. The second return driver is appreciation. So while the investor is holding the bricks and as the homes appreciate over time, that appreciation obviously generates equity appreciation for the investor. And when we sell the home, we know who the buyer is because it's the customer that's already living in the home. And we can sell the home without incurring any sort of brokerage fees or transaction costs. On exit, that's attractive relative to the normal way you'd invest in a single family rental asset. And then what we do is we use leverage within this structure, fairly conservative, 67, 70% or so loan to value ratio at the asset level for each individual property to effectively enhance the returns to the investor so that between, call it 4 to 5% current yield or rental income, 4 to 5% home price appreciation, and then the leverage of that home price appreciation up to 10, 11, 12% equity appreciation, we're targeting a 15, 16% annualized or internal rate of return back to the investor. And so that's really the value prop to investors is 15, 16% IRR. Some of that current yield is tax advantage. So if you kind of take into account that increases your after-tax return in an asset class that historically has performed very well. Is relatively, it's about a third as volatile as the S&P 500 in the long run. So it's a relatively safe investment with a cash flow component and appreciation component. And that's really the value proposition to the investor. And then, to the extent that you care about that, you're also helping fund the way for young people to get into ownership, which is a net positive, right? And so you're helping young people, especially those folks who maybe don't have the families that can help them, the parents that can help with the down payment, get into ownership and get into the housing market.
Okay. So can I ask, how do you determine the market value at that 5-year mark?
So one of the interesting structures here, and this was part of the tech we developed, is we value each home every month. And so the brick, right, back to this notion of, a brick for a $300,000 home on day one is $30, right? That's just 300,000 divided by 10,000. But then a month later, that same home may be valued at, call it 305,000, right? And in that month, the bricks trade for $30.50, which does a couple of things. The first thing it does is it allows the customer to dollar cost average into the home, right? Because they're making a fixed monthly payment, which means they're on the dips, they're buying slightly more bricks. On the peaks, they're buying slightly fewer bricks. And just like investing in a mutual fund or your 401k, that benefit of dollar cost averaging over the long run really results in this nice diagonal line where you're increasing your equity, every month. You're buying slightly more on the dips, slightly less on the peaks. So that's one thing. The other thing it does is it creates a paper trail and a record and a set of statements where the value of the home is documented, and it's documented as a set of transactions where every month you're buying, on average 13 bricks plus minus. And so in any given month, your purchase option or the value at which you can buy the home from Ownify is just the value that we struck in the last month, right? So you always know exactly, what the home is worth and what your takeout price or takeover price, whatever you want to call it, that your purchase option is worth. It's always at the money. It also means that we sell equity at the same price that we're buying equity, which makes it an inherently fair transaction, right? We're a buyer and seller at the same valuation. And that really creates this kind of structure that, customers are going to say, yeah, that's fair, right? I'm buying bricks, and once I'm selling them at the same value, right? Or if I want to buy the rest of the bricks, I'm buying them at the same price that I've bought my 13 bricks last month.
Mm-hmm. So it sounds like you haven't hit that point yet, but what happens if at the end, when somebody doesn't hold their end of the bargain, like they need to 5-year mark, they need to get a mortgage?
Yeah. So a couple of things can happen. The golden path is exactly that, right? You get a mortgage, and we have the mortgage partners and the ability to basically underwrite that for you and say, look, here's your mortgage. Here's how you take it over. This is the change in your monthly payment. And the goal really as a company is to make that transition as simple as, here are the docs you need to sign, right? And starting next month, you're making a payment to a mortgage lender instead of to Ownify, and nothing else changes. And oh, by the way, you now hold title. That's the goal, right? And the goal is to get as many people as possible to follow that path and then ultimately become owners in the traditional way. Well, not everyone will do that, right? And so there's a couple of variations of that path. The second one is someone might say, well, I don't really want to own 100% and have a 30-year mortgage balance that I need to pay off. Why don't I just continue on with Ownify? You can renew in 5-year increments, right? And just keep building equity. So you go to 10% in the first 5 years, you keep going, let's say you get to 20% at the end of 10 years, and you're just an equity-based owner of this home and a fractional owner. The third scenario is one where, for whatever reason, you decide this is not the home I want to live in. I don't want to buy it. I need to move. Life happens. Your family grows. Your job moves to the East Coast. And in that scenario, you can terminate the agreement, and Ownify will buy back your accumulated bricks, also at the same valuation. Now, however, in that scenario, we charge you a relisting fee. And that relisting fee is really the equivalent of what you would pay to a set of realtors if you had bought that home with a mortgage. And generally that would be 6% or so transaction fees that you pay to realtors. And so what we're doing is we're saying, we're not going to charge you 6%, we're going to charge you 4%. And by the end of 5 years, that 4% melts away to 2%. So if for some reason at the end of 5 years, You said, I don't want to buy the home. I also don't want to live it anymore. You can sell us your 10% and we will buy it back. We charge you 2%. So you end up walking away with 8% of the value of the home, right?
Yeah.
Which still puts you ahead of the game. Back to the question you asked earlier, if you had done the same thing with a low down payment mortgage, what really gets you in that scenario is the 6% that you're paying on sale to the realtors, right? That's expensive. That takes a big chunk out of the equity that maybe you would have built over 5 years with a traditional mortgage. Right.
I was going to say, and not only that, in my market, we always get hit on the inspection contingency report. So
Yeah.
in the end, that 6% easily becomes 10.
That can happen, right? And then you add staging costs and marketing costs, and you got to be out of the house while the realtor is showing it, and we carry it for another 2 months. So it's non-trivial to sell a home, right? Because it's a big transaction. And so what we wanted to do is make that a little easier on the exit path as well. The answer is ultimately, it really depends on the individual customer circumstances, right? How long do you want to live in the home? How much can you afford? How much can you put down, right? And the answer on what is the right product for you depends on all of those questions. And so what we've done a lot of work on is building tools and educational content and calculators and agent accreditation and training programs to make sure that we educate the customer and move them into the right product ultimately, right? To say this is the best path for you. It could be Ownify. It could also be, you should really save more and get a mortgage, or maybe you should just keep renting because your time horizon doesn't really lend itself to either a fractional purchase or a full-blown purchase.
Well, I have to ask, Frank, like what you've built here was a gargantuan lift. What are some of the lessons you've learned along the way here?
Yeah, I think the lesson one is it's never as easy as it seems on when you start, right? It's the devil is in the detail. You start unpacking and you start realizing that every step along the way, you're uncovering more and more complexity as you peel the onion. So that's one lesson, but that's probably not surprising, right? Because that's just the reality of any endeavor in life. And then the second one is just don't give up. There's ultimately, you can punch your way through all of these problems. And if the prize is large enough, right? And in my mind, the prize here is the ability to help hundreds and thousands and tens and hundreds of thousands of people eventually with a new and differentiated path. If that prize is large enough, then it's worth the effort, right? Of myself and the rest of the team and all our partners out there to say, look, we're building something new. Yes, it is complex and it requires a heavy lift, but the benefit is really worth it. And ultimately what the benefit boils down to, and this is the kind of thing that really is motivating, is I talk to our customers pretty much every day and I hear these stories of like, hey, Frank, I didn't think I was going to be able to buy a home. I didn't think I was ever going to be a homeowner. And you enabled that, right? Ownify, you and the team enabled that. And that's really rewarding to hear that. And then I think the other thing from an investor perspective is this was a thesis and a theory. And I spent 15 years in the bowels of mortgage math. So we did our homework on the math, but we didn't know whether it really worked until we got a year, 2, 3 years into it. And we're now at the point where the portfolio is performing well. We're seeing kind of all of these theories around like, hey, does co-ownership really create investor alpha? We're starting to see that be true. And that's really rewarding too, right? Both sides need to win, right? The customer needs to win and the investor needs to win. Otherwise, we won't have a scalable model here. We won't be able to attract enough capital to help enough people. So really it's getting that balance right. And it took us a while, but it's really rewarding to see that.
At what point, when this was just an idea, did you decide that this was something that you should bet on and you might be onto something?
At the point where I left my last company, I was CEO of a software company. That was a great job and very lucrative. But I realized that with the knowledge I had gained and the experience I had, I could solve this problem and maybe solve it in a way that others hadn't, right? And then, partnering up with my co-founder and the team and this notion of let's tackle this problem. Yeah, it's a hard problem. It's going to take us a couple of years and lots of capital and lots of effort, but it's worthwhile solving this. So I think it was early on, right? Really the realization that so many young people in particular are struggling. This notion that this is a mind-blowing statistic. Last year, 2024, 50% of first-time homebuyers got help from their families, and usually it's the parents, right? And so what does that mean? It means that if you have parents who have money, great, good for you, right? And, I was lucky when I first came to the US from Germany, my parents helped me buy my first condo. So that's great if you have those, if that's your background. But what about the other half? What about folks who don't have familial wealth or don't want to ask their parents for help? Who's helping them? Where's the structural solution? And that was really one of the big drivers for us to say there has to be a market-based solution. It can't just be that mortgage lenders say, we're not going to lend to you because you don't have the down payment, or you're too risky, or you haven't been in your job long enough, or we don't like the fact that you make money on Facebook, right? There has to be another path here, and that's what we're building.
Sure. Well, before we jump into the rapid fire and close out this episode, Frank, is there anything we should have tried to hit on?
No, I think you asked a bunch of really good questions. The main thing that I'm doing and that we're doing is a lot of education. I appreciate you having me on the pod. This is a different way of thinking about real estate or single family home ownership. There's a real problem we have in this country, which is ownership is constrained and it's getting harder and harder, and we need solutions. We're just one of them. There's tons of others, but we need creative and innovative solutions. I appreciate you giving me the time to be here and talk about it.
Well, if anything needs a little disruption, it's the real estate industry.
Yes.
So again, it's Ownify.com, Ownify.com. I'm going to have that as a clickable link in the show notes. But if you're ready, what lie do real estate investors often tell themselves?
Well, I think right now the lie that everyone is telling themselves is interest rates are going to go down soon and it'll get easier, right? And I don't think that's true. And, if it is true, great, fantastic upside surprise, but I wouldn't bet on it.
If you could go back in time and give your younger self a piece of advice, what would it be?
I think it's getting to decisions faster, right? The benefit of once you're the gray beard and no hair like you and I do, you kind of realize that time is the only thing you don't have in an unlimited supply. So just execute faster, get to decisions faster, call the shots faster. And that may also mean shut things down faster, double down, and make the decisions that are important in your life.
Sure.
Obviously think about them, but just realize that we don't have unlimited time to do things, right?
Do you have a book recommendation, or what are you reading right now?
So I just finished, it's over there, How the World Really Works by Václav Smil. And that was a fascinating book. It basically just boils down our evolution as a species, and in particular, our kind of evolution as capitalist beings, right? What drives infrastructure and society and capitalism into a very basic set of things. So Václav Smil, How the World Really Works.
What single strategy or tool have you implemented that has had the biggest time-saving impact to you or your business?
Probably rigorous prioritization and the ability to create space for deep work. Like everything around you is designed to suck up your time, right? Back to the time comment, whether that's social media or, everything, like your phone pings you all the time with, things that are largely not your priority. And so creating the space early on every morning, I write down exactly what I want to achieve. And then I usually create a 90-minute window, an hour window, and then a 90-minute window where I absolutely do not do anything else. No text, no phones. My wife knows my phone is off. There's no email, no Slack notifications, just this notion of deep work. And there's a great book by Cal Newport, I think, called Deep Work, right? If you can concentrate on something, you can bang out a bunch of work and make a bunch of progress, right? But you need that undistracted time. Prioritization and focusing on deep work are probably two hacks, right? In addition to now I've probably used a dozen AI tools that are doing all sorts of stuff crazily fast and increasingly better for me.
Well, Frank, this was a fascinating episode. I really appreciate your time. One last time, it is Ownify.com, Ownify.com. I hope you'll consider coming back again sometime. That's just been really interesting and great to meet you.
Would love to. Thanks, Jack.